Aloha. I'm Stan Cox, Principal Broker and Strategist with SC Finance Strategies and Insurance Consultants. I'm also the author of the books on the tax-free cash growth warehouse strategy. In my second book, which I wrote in 2019, published in 2019, the title is called Tax-Free Cash Growth Warehouse, Nuts and Bolts, the Infinite Banking Concept in Action. I've been getting a lot of questions and helping a lot of people with investing in real estate recently using this strategy. So I thought I would share this chapter, which is dedicated, it's chapter 4 of Tax-Free Cash Growth Warehouse, Nuts and Bolts. And I'm going to share it with you here in this video. It's called Real Estate Investing Warehouse. Okay. Now, remember that I did write this in 2019, so some of the numbers may not be 100% accurate for today, 2021. But here's a quote from Mark Twain, and I thought this was interesting because it really does apply. What gets us into trouble is not what we know. It's what we know for sure that just ain't so. Funny, but true. Now, the tax-free cash growth warehouse, or TFCGW strategy, has been used by the wealthiest people for nearly 200 years in America. It's certainly not reserved only for the wealthy. Anyone can utilize this strategy. You just have to know about it and get some help to get started with it, because, yeah, you need the right kind of help. That is qualified help, a licensed professional who is knowledgeable and experienced with the infinite banking concept, one who understands and knows how to properly design a contract for the personal banking strategy, the TFCGW strategy. Okay, to be fair, any whole life insurance policy can be used for this strategy, but just like ice cream, not all policy designs are equal. For example, if you're just learning about the advantages of this strategy and you want to put it into practice right away, say for real estate investments, a standard whole life policy is not going to cut it. You want the policy to provide cash value in abundance right away. A standard design doesn't do that. Come back to this in a little while. In Hawaii, real property or real estate is at a premium. Read expensive. So in order to be a real estate investor, you either need to have a good bit of capital or have some associates who do. Since we're here talking about being or owning your own bank for the purpose of investing in real estate as a business, we're going to be talking about some hefty numbers. Bear with me. If you don't have the capital now, by practicing this TFCGW strategy, eventually you will. If you're new to this strategy and do have a load of capital, this is for you. There is quite a premium on having the proper design for the investing strategy, especially for real estate investing, because of the amount of money needed. There are a couple of ways to go about it. If you can, if you have enough money to start with, fully finance your real estate purchases, or you can just finance the down payments on your real estate purchases and go from there. For this scenario, as previously, we're basing this example on a client experience. So we're going to go with the cash-rich version. Then later, we'll go into the breakdown version. Here in Hawaii, the average price for a single-family home, a single-family dwelling on its own lot, is around $650,000. A condo is averaging around half that at $335,000. So you would need some significant dollars to throw down to buy outright any real estate here. And I believe the most current numbers on average or median single-family dwelling is now like $775,000 here in Hawaii. And condos, I'm sure, are closer to $500,000 now. Obviously, the tax-free cash growth warehouse policy needs to be designed for the maximum efficiency of your cash value. Let's go through the numbers first, then we'll discuss the design. So let's start with an average condo purchase at $300,000. And I'm keeping to easy numbers for the purpose of illustration and calculations. Again, and that's a low number, more than likely. Again, this scenario is for a new account being set up for the purpose of real estate investing. So we'll say your warehouse starts off with $350,000 in cash value that you can access via policy loans. I'll come back to this when I talk about policy design. In this example, we're going to pay cash for the condo purchase, but we're going to use the value of the tax-free cash growth warehouse via a policy loan. This exact strategy can also be used when using the cash value as collateral for a policy loan as a down payment for a larger real estate purchase. One huge advantage of using a policy loan to pay for real estate purchase outright is that no mortgage loan is being used. The big disadvantage of mortgage loans is that they are amortized. So even though a mortgage loan may be at just 4% and the policy loan is at 5%, the policy loan is simple interest, which saves many thousands of dollars over an amortized loan at even a lesser amount. I know that mortgage loans currently are available at under 3%, but they are on the rise again. And again, I wrote this book or published this book in 2019. So the numbers, just go with it. As I was researching the data for this example, I discovered that current mortgage interest rates have increased and looks like 5% or more is what is being offered these days. So we'll use 5% as the mortgage interest rate as well as the policy loan interest rate. But again, remember, mortgage amortized, policy loan interest, simple interest. At the current dividend interest rate of 6.4, again, that was 2019, compounding interest, in the worst case scenario, you still earn a positive 1.4% above the 5% simple cost of the loan. Actually, it's greater positive cash flow than that because while the loan interest is simple interest, the dividend interest is compounding. Again, keeping it simple and using the worst case scenario, you're gaining 1.4% on the money you use to buy the condo outright. At the same time, the condo should be appreciating in value. Here in Hawaii, property values are appreciating between 5 and 10% annually. So whatever the actual gains are on the real estate, add another 1.4% net. Another huge advantage to using the TFCGW strategy for this is that while the gains you are realizing on your TFCGW inventory, cash, are completely tax-free, all the interest you pay on the policy loan are also deductible from your income tax liability. Whether you're investing in this property for rental income or to resell it for profit at some later date, it is advisable to create an LLC or an S corporation or other business entity to run these transactions through. It just makes it easier to take the tax deductions as business expenses. While it's not required to make a repayment schedule for the policy loan as a business person, you do want to schedule regular payments on it so you can rebuild the availability of your cash value for other uses. Let's look at the numbers now and reveal just what a huge advantage this strategy provides. First, you've avoided the massive interest charges of an amortized mortgage loan on a $300,000 mortgage at 5%, fixed over 30 years. The interest charge to the loan and then front loaded would be about $218,000 or 73% of the principal. That's what amortized loans do. And that's what mortgage loans are like. So using an online mortgage amortization calculator, it indicated that 5% plus is the current going rate. And this is how I got the interest paid on this mortgage amount. At the 5% simple interest for the policy loan and paying it back at the same rate calculated for the standard 30-year mortgage, the monthly payments would be $2,018 or $22,725 per year. This way, the policy loan is paid off in 19 years, and total interest paid is $132,000, saving you $86,000 in interest and 11 years in payoff time. Let's review and compare. Going the standard route and taking a 30-year fixed mortgage at 5% would have you paying $218,000 in interest on top of the $300,000 principal purchase price of the property. That equates to $518,000, on which you also have lost opportunity costs of 6.4%. At 6.4% compounding interest, $300,000 would grow to $975,000 over 19 years, the time it would take to pay off the policy loan, not the mortgage. But let's just keep it to the 19 years time frame for this comparison. That's an opportunity cost or loss of $675,000. Plus the cost of the purchase, including interest of $518,000, you would be out $1,193,000 for a $300,000 condo. If the property increases in value at 7% a year, which is somewhere between 5 and 10%, right? It would grow in value to $1,084,857 over the same 19 years. That means that with the standard financing, and remember, we're not including the additional 11 years of opportunity cost here that the 30-year mortgage would have you paying on this, you're still backwards $108,142, even with the gain in the property value. Now, using the tax-free cash growth warehouse strategy, your TFCGW inventory or cash value has grown to $975,000, and your property has gained in value $1,084,857. That's $2,059,857 minus the cost of the policy loan of $132,000 and the purchase cost of the property. You come away with a gain of $1,627,857. And that does not include the lost opportunity cost of $675,000 that you save using this strategy. And of course, the interest paid is also a tax deduction for you as a business expense. Now let's look at the TFCGW policy design for this application. We need to front load the cash value by $350,000. So the MEC or modified endowment contract limit will have to be pretty high so we don't lose the tax-free cash growth advantage. With that in mind, we'll use a 50-year-old male non-tobacco user and standard rating for this example. I mentioned that we need to have a pretty high MEC limit, and that's primarily based on the face value, otherwise known as the death benefit. So this policy will be designed with a face value of $6.5 million. In order to keep the premiums at the lowest we can for this client, we're going to create a policy designed with a combination of whole life and a term supplement. The annually renewable term has smaller premium for the amount of insurance and allows us to keep the premium down a bit. The $6.5 million total face value design gives us a MEC limit of $414,000. So we can front load the policy with the needed $300,000 plus the first year premium for this investment strategy without losing the tax-free growth advantage. We also have a video here that explains the modified endowment contract in more detail. Because this policy is just being started with the insured client's age being 50, the premium is considerably higher than it would be for a 20 or 30-year-old. In this case, the annual premium is set at $93,000. Because we front load the account with the $300,000 as paid up additions, the initial face value is actually $7,290,000. We can drop the annual term supplement at year 8 in order to drop the required premium and still not make the policy. By doing this, the premium drops to $42,600, so the face value also drops to $3.5 million. However, both the face value and cash value continue to grow. By year 20, the cash value has grown to $2.28 million, and the face value is back up to $5 million. By year 15, dividends being paid are enough to cover the annual premium. So at that point, the dividend option could be changed to reduce premium instead of paid up addition. And from that point on, there would be no more premium payments required. Another option would be to initiate the reduced paid up option. That would calculate the total amount of insurance paid for at that point and reduce the face value to that amount. Then there would be no more premium due at all. And the dividends would then continue to buy additional whole life insurance and add to the cash value of the account. Here's what the projected values look like without exercising any of the options we just discussed and continuing with the annual premium of $93,000 per year. Okay, the cash value at the end of the first year is $332,886. Death benefit is $7,293,401. Year 1, 2, 3, 4, 5, 6. Year 6, the cash value is at $804,809, and the face value death benefit is at $7.3 million. And year 10, the cash value is at $1.27 million. The death benefit is at $7.4 million. And what is this, year 15? Cash value is $1.67 million. Death benefit, $7.5 million. Oh, no, that's year 13, sorry. You can see that the cash value is growing at well over the rate at which premiums are being paid in. By year 4, all the premium is being credited to the cash value plus an additional 8.3%. By year 13, the additional amount paid into the cash value above the premium is 68%. By year 10, the cash value exceeds the total premiums paid in, and the compounding dividend interest causes the cash value to grow like a snowball rolling down a powdery hill. The last year shown is year 26 in the book and the chart I have in the book. And it makes the owner of the policy in year 26, 76 years old, having started this policy at age 50. At this point, he could buy 10 $300,000 condos outright with the cash value built up in this policy. And without even paying back the policy loan, he'd still have $4 million of death benefit for his heirs or favorite charity. The breakdown version I mentioned at the beginning of this chapter is simply using the cash value to make the down payment on a real estate purchase. But the strategy works exactly the same way. And you would want to repay the policy loan in the same manner. So let me give you that ending year there, year 26 cash value of this policy, as we've been relating, is $3,783,660. Death benefit is $7.8 million. This has been chapter 4, using the tax-free cash growth warehouse strategy as a real estate investment warehouse. And I hope this has been enlightening, and hope it's opened your eyes to how really fantastic an asset this type of a policy and strategy can be for you. We're here to help. We're to answer your questions. All our contact information is in the description box below. Please subscribe to this channel. Post your questions and comments here. And if you'd like to chat with us, maybe help, I'll review a policy if you already have policies. If you want to get something started, I can answer your questions. We can go from there. But yeah, I appreciate your watching. Mahalo and aloha.